Hi, welcome to the Guaranteed Retirement Guy Show. My name is John Stevenson, and we're going to be talking today about the difference between an indexed annuity and how it compares to a fixed annuity, or what we would call a MYGA contract. Okay, so let's talk about fixed first. Fixed is really what it is called. It's called a fixed annuity for a reason, because you get a fixed rate. It really is the annuities world, the annuities version of a CD. Okay, so let's take a look. And I'm going to share my screen, and I want you to actually see what these look like. Now, of course, this is based off of higher rates right now. If you're watching this video later, the rates might have fallen. So it just depends on, obviously, market conditions. But you can see with high rates right now, we're in the fives. You know, a couple years ago, this was only like 2%. So pretty good. And this is just showing the top three for all of these different periods of time. So if I go over here and say, all right, well, what's the top 7-year MYGA annuity? Well, you can see the top is a 5.8 from Heartland National, followed by Nassau, 5.75, and then American National, which is A-rated, is 5.6. And if you're thinking, hey, I want A-rated and I'm okay with having $13,000 less in overall earnings over 7 years, then it's great. So it's a Palladium, and I sell it a lot. It's American National. I also sell Nassau and Heartland National. They're both good in my opinion. So you just have to decide what kind you want to work with, what kind of company, and of course, work with someone like me who knows the differences. And of course, I'm going to show you in just a little bit what the indexed annuity and why you should consider that as well. Okay. But let's take a look at this. If I want something with a withdrawal, right? Maybe I want something that will allow me to withdraw some of my principal or even some of my earnings, then you need to consider, well, American National will give me 10%. Okay. Nassau doesn't give me anything, versus Heartland, they'll only give me interest only. So if you want the ability to take more money out, then American National definitely gives you more of that. So let's take a look at that and say, well, all right, well, what does a fixed rate look like for me? So if I go in here and I'll say, again, this is based off of 650,000. Your numbers could be different, but we want to make sure that we get the highest amount for a 7-year period, and we want it to be an A-rated company. And so based off of that, our 650,000 grows to a guaranteed 951,833 at the end of 7 years. That's phenomenal. Now, if I wanted to take withdrawals out, I can. But what if I don't want to take withdrawals out in the first year? Maybe even the second year. Maybe I want to wait till after 3 years of growth. Well, after 3 years of growth, we've got an account balance that's worth $765,429, which means if I want to take a 10% withdrawal, that's $76,000. Pretty good. That's nice. So if I want to take extra money out more than what it's earned in that last period, I certainly can. Or if I just want to live off the interest, then maybe I could just take out $40,000 a year until the end of the contract. I could do that too. So that's a nice thing about a MYGA contract or a fixed annuity is you get a fixed rate. It never goes up, never goes down. What you see is what you get. And of course, at the end of that term, if you let that thing compound, you're going to have a nice sizable amount to put into something else. Okay. So that's a MYGA. I sell a lot of those. And of course, you know, for good reason. We've got high rates right now, and people are just looking for something that's safer than the market. And they want something that is making more than what maybe their high yield savings is doing, or money market, or maybe they don't want the fluctuations of the bond. They don't want to purchase a bond and then have prices on that fluctuate. And they want to make sure they have a high yield. And so annuities can be a very good addition to a portfolio that is looking for growth, but also moderation and protection from other risks. Okay. So, all right. So that's a MYGA. MYGAs, they give you guarantees. It's a guaranteed rate no matter what. Okay. If the market's down, you're still getting that guaranteed rate no matter what. Okay. If the market's up, you still get the guaranteed rate. So you miss out, of course, on higher earnings. And you don't have the opportunity to attach an income rider if that is your goal. If you want high income, that is usually a big no-no to get a MYGA versus an index annuity with an income rider. Okay, so let's go back here and say, all right, well, we've already looked at the fixed. Let's look at the index. Okay, let's see. What can we get with these index annuities? All right, so I want to just, let's see here. Same client, same $650,000. Okay, and I'm just going to grab one of these. Okay, we'll grab Athene. Okay, and then we're going to grab their Agility 7. So we look at this and say, all right, well, what does an index annuity do for us? Well, quite a bit. Look at the UBS index. They're giving us a participation rate of 100%, which means they'll give us all of what the index earns, okay? Which right now, the average return over 10 years is 8.95, so basically 9%. So of course, that's why you can see the default is in this one. They do have, looks like another index, but it's not available in this particular annuity. So it's available in some of their other annuities, but not in this one. But again, 9%, not bad. And you can see there are other variations, other different indexes like the NASDAQ, the S&P. Got different variations of the S&P, different variations of the U.S. equity index. They got an AI power. There's just lots of cool stuff you could do now. And then, of course, you got some crazy ones over here, the 2 years, where it basically will not credit your account until 24 months have passed. So the downside, of course, is you have less compounding periods. So usually I tell people, put a lot of your money into the 1 year so you can just have more opportunities for compounding. I want that growth to, I want you to get as much growth as possible. The other downside for a 2 year is, what if you have a ton of growth in the first year? What if you make like 20%? Okay. But of course, it's a 2 year. So the second part, second half of that 2 year, maybe the index goes down 75%. Now you've lost most of the upside you've already gotten. Okay. So that's something to consider. That's why I like having 1 year intervals, because if I can capture everything that happened in that first year, and then the second year it does nothing or goes down, then I don't lose anything, but I don't make anything, but I certainly don't lose the first year's growth. Okay, so something to think about when you're looking at putting your money in different allocations for those indexes. Now, here's what you have to remember with these indexes. And of course, you can see they have a fixed account too, kind of similar to a MYGA, but it's paying you less, so 3%. If you're gonna do a MYGA, if you want a fixed, highest fixed, go to a MYGA. Okay, MYGAs are always going to pay out higher than any fixed account you'll get with an indexed annuity. But if you do an indexed annuity, okay, put it in an index. Okay, with these indexes, they're paying out quite a bit. Now, it is also based on the participation rates and the cap rates. And they'll cap those, they'll change those according to whatever their costs are at the moment. So every year, that is subject to change. So if they're buying options that are really cheap right now, you're going to get a good par rate, a good cap rate. But what if option prices take, maybe they take a huge hike, okay? And now because of that, the same $5 billion that this insurance company is investing into options all of a sudden buys them half of what they got this year. Well, guess what they're going to do? Yes, they're going to lower the participation rates and the caps because they got to make sure they make a profit. They got to make up for the higher cost of those option contracts. So that is, I guess, the risk of putting it into a fixed index annuity is because you never know what the market's going to do. You never know how the index will perform. Of course, they have some very, very good projections because of what they've done in the past, but you never know. Okay, so you have to think about that when you're putting money into a fixed versus a fixed index product. Okay, the index product overall, over time, usually will outperform a MYGA all day long. Okay, and of course, you can attach an income rider. Okay, that's the other thing to consider. So if I go in here and say, all right, well, I want income with this, you can't do a MYGA, you can't do a fixed annuity, you have to do an index. So I'll go in here and say, all right, well, what does the income rider look like? And of course, it's on a fixed index annuity, so it'll still earn, which is good. And of course, I want to make sure that I get income on top of that. So I'm going to have income plus I'm going to have an index that grows when it does grow. And of course, when the market goes down, my money is completely and 100% protected from market losses. So if I look at the same thing, all right, $650,000, I'm going to defer income, joint income for me and my wife for 10 years. Okay. I'll take it to 70 and maybe I'm going to wait till then to take my Social Security. Okay. Well, if I look at that, it shows me all the highest income. So if I looked at, all right, well, highest income is Equitrust, $106,000 guaranteed. That's because I have the income rider attached, okay? But what if I want an A-rated? Well, highest A-rated is $100,000. Well, that's not too bad. I mean, it's only $6,000 less. So I said, all right, well, I'm just going to stick with the A-rated. Let's say North American or Midland. They're sister companies. They're completely separate, but yeah, one of them's like 125 years old. The other one's 119. So really, really good companies. I work with them all the time. But if I went in here and say, all right, well, I want the highest income for an A-rated company. Well, North American is the highest. So we'll look at that and say, all right, well, here's what it looks like, because you got to look at worst case scenario. If the index earns nothing, right? That's the worst case scenario for an index annuity is if it does earn nothing, if for some reason the market shuts down, you're not going to earn anything. And your $650,000 will stay exactly the same. That's the downside, but it's also an extreme scenario. Now you'll notice this one though has $650,000 going down. Why is that happening? Well, it's because you chose to have the income rider attached, okay? You see the rider charges over here? Yeah, they're charging like 100 grand of rider charges over 10 years. But of course that 100 grand of rider charges is going to give you a ton of lifetime income, okay? I mean, a ton of income. We're talking by the time, let's see, you reach age 89, they've paid out $2 million in income. And if you live another 10 years, you're going to get another $1 million in income, okay? That is what is so valuable about an income rider and why it is worth every single penny that they charge you for it. All right, so again, and they show you, these are crazy scenarios. They're showing you, hey, look, if our indexes here just do really, really awesome, which income, the income pay pro 10 with North American has some pretty decent indexes. That's why they're showing these 23% growth. And that's why they're showing this account balance growing to $4.2 million by the time you're 89, and you've already taken out $2 million in income. Yeah, that's great in a perfect world, but those are really, really high returns. So let's look at the allocations. Look at the allocations here and say, all right, well, where are they basing this off of? Oh yeah, the 2 years Barclays. So yeah, they're basing off of 11%, right? Okay, well, maybe that'll happen. But again, I like to be a little bit more conservative when I look at these indexes. So it's not that I wouldn't put you into this. Like if you purchase an annuity, I'd probably spread you out over these top 1 year and 2 years. But for illustration purposes, I'll say, you know what? What if we don't get it as good as what it's projecting, right? I'm just going to allocate it over these ones that are not showing as high of a return to see what it would look like now. Now, of course, your income's never going to change. The income, it's guaranteed, okay? It is regardless of your account balance. Because remember, worst case scenario, your account balance goes down, the index earns nothing, and you still have your guaranteed income. Okay, so let's look at this. Well, let's see. This is more average. This is better. I like this. So basically what they're showing is if this grows to $1.1 million, great. They're still basing the income off of 1.4 million because they're taking 1.4 million multiplied by 7.15 and giving you that 100,000 a year, guarantee the rest of your life. But if the index has pretty decent growth, then your account balance will still go down because of course you're taking a ton of income, and that income is guaranteed for life. But by the time you reach 89, it's only, your account balance is only worth 163,000. So probably by the time you reach 91, 92, the account balance is at zero. But your income, it's still there. It's guaranteed, right? So if you live another 10 years beyond that, you're going to take another $1 million. Okay, it is irregardless of what the account balance is. Okay, that is what is so special about these. Now, keep in mind, if you die, see the death benefit over here? Yes, that is what your beneficiaries will get paid if you pass away. You and your spouse pass away, they're going to get that. Okay, they won't get your $100,000 a year income, but they will get your account balance. Okay, so remember that basically corresponds with the contract value. So whatever is in this contract value is what they're going to get as far as the death benefit. Now, income, completely different. The income rider you're paying for, that is paying for a guaranteed growth rate. That's why you got a 1.4 million over here. It's not a cash value, but it's a 1.4 million benefit base, a income benefit base that's multiplied by that 7.15. That is what determines your income. Okay, and you have to remember up here, worst case scenario, even if the account balance here does not grow, the index does nothing, you are paying for an income rider, and that income rider gives you guaranteed growth. Okay. And that guarantee is a 1.4 million times 7.15, giving you that $100,000 a year. All right. So I hope this video helped. It's a long video and I apologize for that. I hope you had a chance to watch the whole thing because there is a lot of good nuggets in this. There are major differences between a MYGA, a fixed annuity, and an index annuity. You have to be aware of those before you purchase one. Okay. So if that makes sense and you want to talk to someone who is transparent, please book a call with me. If you want to book a call, there is a link below this video, just like all of my other videos, okay? And it goes straight to my calendar. And we'll talk about your unique annuity needs, okay? If you want a MYGA, great. If you want a fixed index annuity, maybe you want an income rider, we'll talk about those, okay? I'll show you everything that's available. Okay, I'm not going to hold anything back. And, I'm not going to try to sell you anything, but if there is something that is going to work for your situation, I'd love to help you set it up. So Again, like, subscribe so that you can get all of my content. And I appreciate you watching, and we'll see you in the next video.